Terrific. Thank you, Jen. Again, good afternoon, and thank you for joining us for our webinar today, Gift Planning in a Capital Campaign. My name is Nathan Stelter, the president here at the Stelter Company, and I'm happy to be here to introduce our presenter, Mike Degenhart. But before I do, I'd like to say just a couple quick words about our webinar series if you're not familiar with it. But as an industry leader in plan giving marketing, Stelter has been committed to providing innovative solutions and education for industry for a long while now, and are always happy to host these complimentary webinars, as well as a whole slate of webinars throughout the year. Today is actually our 8th webinar in our 2019 curriculum, our second to last. We do actually and have added one more here coming up as a special holiday treat, I guess, where actually I will be presenting this next month, December 11th. This is a topic that I gave at a couple conferences earlier this year on trends in gift planning. That was not earlier announced, but is now active and available on our website. So you can go to the stelter.com/webinars and register there. We'll always and also be sending out an invite straight to your inbox as we get closer to that date. We are currently planning our 2020 webinar series, and so as always, upon completion of this webinar, or just sending us an email afterwards, if there are any topics or specific speakers you've seen and would like to have them included in our discussion, please do respond to the post webinar survey or send us an email separately. Now back to the presentation today. Very happy to have a longtime friend and colleague of mine, Mike Degenhart, on the line today. He currently serves as the Assistant VP of the Office of Gift Planning at the Pennsylvania State, Penn State University, where he's responsible for development and implementation of their university-wide plan giving efforts for Penn State's 24 campuses. At Penn State, Michael and his office have been tasked with an overall combined gift planning goal of $130 million annually. He's a key member of the senior management team that has directed Penn State's recently completed $2 billion campaign and its current, as it sits, $1.6 billion and change campaign. Prior to Penn State, Michael was a VP over at Syracuse University and spent 7 years in the Office of Trust, Estates, and Gift Planning at Cornell. Mike has been a consulting vice president for Grenzebach Gleer and Associates, GG&A, since 2010. If you're not familiar with GG&A, they're a leading international consultant to nonprofit institutions and organizations of all sizes, and one of the foremost authorities on fundraising best practices. Mike has over 25 years of financial, state, and charitable planning experience. He earned his BA from the University of Wisconsin, who actually beat my Hawkeyes last week, and an MBA from the University of Rochester's Simon School of Business. He's an accredited estate planner and chartered advisor in philanthropy. I am very happy to hand over the reins for today's conversation to Mike Degenhart. Mike, all yours.
Great. Thank you, Nathan and Jen. Can you hear me okay? Great. I'm excited to be here to discuss gift planning and a capital campaign. I've worked personally on $4 billion plus campaigns at the institutions I have served, but I've also helped numerous nonprofits with with campaign planning through my work as a consultant. No matter the size of the institution, the issues are the same. So if you're with a small charity, what we talk about today, these issues will apply to you equally. I made this presentation last year to the Plan Giving Council of Greater Philadelphia, and it sparked great questions and conversation, and hopefully it'll do so today. As you see from the agenda, I've broken this presentation into 4 sections. First, I want to set the stage of why gift planning and the capital campaign is important. Secondly, I want to discuss issues and strategies for effectively integrating gift planning into a capital campaign. We will then take a break for some questions. Thirdly, I want to provide some ideas and solutions around gift acceptance, counting, and recognition, as these are the questions I get most often. And lastly, I want to discuss performance metrics to help incentivize staff to initiate plan gift conversations and to work collaboratively with their gift planning colleagues. I will use the terms gift planning and plan giving interchangeably, and I'll also use capital campaign to describe endowment campaigns, bricks and mortars, so it's sort of all inclusive. There have been many studies on the current wealth transfer. The most famous is probably the Boston College study that revealed an estimated $59 trillion to be divided among heirs, charity, and estate taxes. That'll be transferred from 116 million American households between 2007 and 2061. Sort of the greatest wealth transfer in U.S. history. A great resource to read about this and other studies is the research section on the Boston College Center on Wealth and Philanthropy's website. But the slide you see here is a study I saw last year that was conducted by AgeWave that describes over the next 2 decades a surge in giving by retirees. And 3 forces are converging to create this phenomena: the movement of the massive boomer generation into their retirement years, increasing longevity, which means more people may spend more years in retirement. The aging of the boomers and increasing longevity will drive the age 65 plus population up by 57% over the next 2 decades. And there's a higher rate of giving among both retired men and women, especially women, of both time and money. As we know, there's a huge wealth transfer underway. The wealthy give a smaller percentage of their income, but more in total dollars. We're seeing that at Penn State, as I assume you are at your institutions. Some statistics I would like to put out: about 48% of Americans currently have wills. Of those, 8% are utilizing charitable bequests. Another 31% is considering charitable bequests. Of the people who have charitable bequests, 97% do not ever revoke those. 73% of people who have charitable bequests never inform a charity of that will provision. And of all the planned gifts that are received by institutions, almost 90% basically are bequests that are coming in. So what does this wealth transfer mean for nonprofits? It means there's going to be an extraordinary amount of additional money coming into the nonprofit sector over the next generation beyond annual giving levels. The nonprofits that are positioned to speak to donors knowledgeably about planned giving are going to be the recipients of a large portion of these funds. So if you're not doing gift planning or talking about it, you have to start now. The overwhelming majority of planned gifts that will come in the form of bequests. So development officers do not need to be experts in planned giving in order to work with most planned giving situations. In other words, don't let the fear of CRATs, GRUTs, all the little acronyms you hear scare you away from gift planning. As this chart shows, wealth is held not in cash, it is held in assets. If you're asking for cash, you're asking for the small bucket. Nonprofits that are positioned with a well-functioning gift planning program will have success. It is important that gift planning be part of capital campaigns so you can help your donors increase their current income for themselves and others, reduce income and or estate taxes, avoid or reduce capital gains taxes, pass assets or businesses to families at a reduced tax cost, and also make significant donations to charity as they otherwise would not or could not achieve. So you might be asking, this is all well and fine, but why should I bother with planned giving in the capital campaign, given the amount of work that is needed for a campaign alone and the reality that we need cash now as opposing to waiting for a planned gift to come in? So should gift planning be included in the capital campaign? I get that question a lot, and the answer is yes. But I also hear, but why? And it's because it opens up a broader gift conversation, expanding opportunities for donors to give. It includes a larger audience of potential donors in our gift discussions. And lastly, it increases the likelihood of blended and therefore potentially larger gifts. And we'll get into this more in a minute. Gift planning is an essential capital campaign component. Campaigns have changed over the years. They've gotten larger and more complex. And the organizations that aren't asking for planned gifts are not counting and recognizing planned gifts are in competition for dollars with other charities. The organizations that are including these types of gifts are doing better. Boomers are concerned about the cost of retirement, education, healthcare, parents' needs. Planned gifts help solve these concerns. There's also a deeper relationship with donors, and that we have to be more critical to the sensitivity of their needs and the ability to be creative and provide flexibility. Many of our loyal supporters, even those who hold significant assets, may answer yes, but when asked to contribute to a campaign. Not because they do not fully support your mission, but because they have important financial considerations that compete with the deepest desire to give. That is why gift planning is so critical in capital campaigns. Planned gifts represent anywhere from 10 to 25% of campaign dollars. At larger universities where I've been associated, planned gifts have represented 25 to 30% of our campaign totals that I've worked on. Planned gifts also represent extraordinary return on investment. The cost to raise a planned gift is lower than the cost to raise a major gift. If you can raise $135 million in planned gifts like we did last year at Penn State, the cost to do that is a lot lower than to raise that much in major gifts. So it's very important to have planned giving as a component in campaigns. When I consult with nonprofits, the other question I hear often is why gift planning in a campaign? A lot of smaller charities who have limited staff or maybe have one person doing gift planning feel they just can't commit the time to that. However, I tell them if they can find a dedicated staff member or a dedicated team to work on gift planning, they can jumpstart a planned giving program. You know, if you're out asking for planned gifts, talking about bequest expectancies, you're going to grow your program, raise money for future needs, and also have the ability to ask those donors to early activate or make annual gifts to support those future needs. The other important reason gift planning needs to be involved in a capital campaign is it creates awareness. It allows a nonprofit the ability to educate not only their donors and prospects, but also their staff, volunteers, and trustees. It provides a sense of urgency to close gifts. By having a definitive timeline with a campaign, you can go out and ask people to include your organization in their will or estate plan so you can properly recognize them during the campaign period. It also uncovers existing gifts and values from your donors. A lot of times when you survey your donor base to find out why they're supporting your organization, why are they passionate about supporting your causes, asking a few questions in surveys, have you included our organization in your will or estate plan, you are going to uncover planned gifts you were not even aware of. And lastly, it helps build your prospect pool. So what are some strategies for effectively integrating gift planning into a capital campaign? I believe there's 4 overarching strategies that lead to success. First and foremost, you have to have metrics in place for your gift officers. You also have to create partnerships and have abilities for gift officers to collaborate. Second, you need to have a close working relationship with your finance and business office. In order to be effective, you need a finance and business team that works with you collaboratively, because a lot of times they're not familiar with gift planning vehicles, the due diligence needed in more complex gift arrangements, so you need an effective working relationship. Third, you need to integrate gift planning into donor strategies. As you look at a prospect, you really need to think, in addition to a major gift ask, can we add a planned gift ask or a blended gift ask? You know, what does the donor want to support? What assets do they have? So I think it's important for donor strategies to understand the donor's assets, what's the best vehicle, and what's the best timing. That timing could be an outright gift or pledge, but it also could be a future planned gift. Lastly, marketing and promotion of planned gifts. Nonprofits need a well-developed marketing plan and should be working with a vendor such as Stelter to help them develop a marketing and communications plan. I'm not an expert in marketing, but I'll give you my thoughts on what the right marketing strategies are. Unfortunately, most nonprofits do not have the time, skilled personnel, budget, and or inclination to launch a comprehensive plan giving marketing program on their own. Utilizing a vendor like Stelter can assist with the creation of a marketing program and plan. If you do not have a well-defined marketing and communication strategy, the right strategies, in my opinion, are to develop materials that work best with personal visits and follow-up, appeal to a prospect's passion and interests, and create a motivation for them to act. Determine who your best prospects for gift planning are through data mining. One of the best things you can do is to promote plan giving by showing donors what other donors have done. Remember, often it's the actions of others that spur us on. I'm a big believer in utilizing donor testimonials in your marketing. It is something I've done with all the institutions I've ever worked with, and to great success. As I said, I'm not an expert in marketing. I've relied on firms like Stelter throughout my career. My last thoughts on marketing: you need to play to your strengths. It's usually cheaper and more effective than trying to do elaborate plans in-house. Donor information should be geared to your marketplace. Smaller charities who are getting mostly bequests should market bequests and focus on that. Donor recognition needs to be geared to the size and type of charity you are. Larger institutions like Penn State, where I work, can have more complex and elaborate donor recognition, but smaller charities need to focus on the basics, thank people for gifts, create a legacy society that we'll talk more about later, and just be thankful for what they get. And also use the existing vehicles you have for donor recognition. If you have donor honor rolls for your annual outright gifts, consider adding planned gifts to those marketing recognition efforts. In order to effectively integrate gift planning into a capital campaign, you will need to establish gift acceptance policies. What I've seen when I worked with nonprofits is that most development activities and gift acceptance usually focus on cash and occasionally marketable securities. There is little discussion of or involvement with other gift forms. Gift acceptance policies are a product of capital campaigns and planned giving campaigns in which planned gift concepts are used, such as gifts made from assets, life income gifts, and deferred gifts are being introduced to your donor base. Gift acceptance policies need to address what type of gifts your organization will accept and the policies and due diligence around accepting those gifts. Most large institutions and larger charities that have been doing this for a while have well-defined gift acceptance policies, but smaller charities who are just getting into the gift planning realm have not really thought about what needs to be in those gift acceptance policies. In addition, nonprofits will also need to establish and update their gift counting policies, and we will cover this in detail later in the webinar. Lastly, nonprofits will also need to update their prospect management policies, because over the past 40 years, planned gifts to charitable organizations have grown on average 4.5% to 5% every year, even in years experiencing economic downturns. With such a proven track record, it's only logical that nonprofits and development leaders should seek out ways to improve and increase their planned giving programs. Traditionally, planned giving cultivation starts by mass mailing newsletters or targeted informational pieces to suspect groups of older, loyal donors. Many programs never advance beyond this technique or consider engaging middle-aged planned giving prospects. While other nonprofit programs implement sophisticated identification and marketing plans to better target and cultivate highly cultivated planned giving prospects, just simple prospect research provides an additional tool to both identify and solicit not only from the organization's larger prospect pool, but to elevate the charity's most capable constituents to the major gift level. Loyal donors are the best people to be marketing to. But there's also people who have assets that can be contacted. At Penn State, we do a lot of data mining around publicly traded stock, closely held businesses, second homes, real estate. We have a sophisticated data mining program and data analytics, but you don't need that to do data mining. Any organization can look at the prospect pool. The ideal time to include or implement gift planning into a capital campaign is when a nonprofit is doing the campaign planning. When you are doing campaign planning at a feasibility stage, it's important to look at your campaign goals and determine, is there a place for planned gifts in the campaign? It's an excellent time to get buy-in from the start, from your campaign leadership, from staff, volunteers, key donors. It also establishes that gift planning is not a fallback. If we ask for a major gift and we don't get it, we're going to ask them to put us in their will or estate plan. It's not a fallback. Gift planning can transform organizations. Gift planning also requires regular reporting, and doing it in the campaign structure is a great place to start a program and implement it. So at this point in time, I'd like to take a break and see if there's any questions that anyone has before we move on to gift counting.
Sure, Mike. We do have a couple questions that have come in. A couple of them are particular to what you've spoken about so far, so I think we'll go ahead and cover those, and the rest, I think we'll save those to the end because they're a little more general, and you might also touch on that in the next part of your webinar. So we had two questions that came in kind of about the ROI of planned giving. You talked about how it was more expensive to raise a major gift than a planned gift, and we have both Jennifer and Brett who are wondering if you have some more details around the cost to raise a planned gift versus the cost to raise a major gift.
Sure. A few years ago, there was a great article in the Journal of Gift Planning that Kristen Dugdale, when she was at the University of Colorado Foundation, did around trying to identify the ROI in gift planning programs. But basically, what you try to do is discount future gifts. So if you're getting bequest expectancies in, that might be 20 years before they will mature, and they might be worth $1 million, you discount those based on a factor to try to determine what the actual value of the gifts you brought into the door. So when you raise a life income gift, we value that basically at face value when we're looking at ROI. But then when we get future bequest expectancies, we are discounting those. So I use different factors, and it's based, I think each charity would determine what's the best factor to do that. But if I'm bringing assets in the door, like life income gifts, to me, we credit them and count them at the same value as an outright gift. So if an outright gift might be a $100,000 outright gift that's going into endowment, our life income gifts we credit and look at the same, and then we discount future gifts to look at an ROI number. So I determine a number each year for my management on what I think the cost to raise those planned gifts we brought in for that year were. And I'm happy to share that article with the people who asked the question, as that really lays out the framework better than I'm describing it right now.
Yeah, actually, if you want to share that with me, I can make that available along with the slides and the recording after the webinar. I think that would be very helpful.
Okay, great.
Okay. Another question came in from Robert. He's asking if for your campaign goal, are your planned gifts counted as a pledge, or how do you count that?
So when we get a life, and I'll get into campaign counting in the next section, but basically we count the gifts in our campaign as commitments and receipts. So any planned gift that comes in that is not cash in the door, so a future pledge, we count as a commitment. So what we try to do is look at commitments. So a commitment goes on our record, gift database, as a future pledge. So we have major pledges and we have future pledges. But all planned gifts are commitments. Some planned gifts are commitments and receipts, like a gift annuity or a life income gift, because that's also cash in the door. So we count it as a receipt also. So yes, all our planned gifts are counted as pledges, depending what category they fall into.
Okay. We do have a lot of questions coming in now. I'm kind of trying to sort through them, so I think we'll go ahead and save these. Nathan and I will look through them, and then we will present these to you at the end of the presentation, if that sounds okay.
Yep.
Okay, great. Thanks.
And hopefully, once I start talking about how to count gifts, what to count and how to count it, this will become clear. Back in 2006, the organization that is now the National Association of Charitable Gift Planners, CGP, so NCPG and PPP, released guidelines for counting and reporting planned gifts that provided groundbreaking tools for counting, recognizing, and reporting planned gifts. Since then, hundreds of nonprofits have utilized the counting guidelines that has increased the visibility, impact, and role of planned giving programs nationwide. In 2008, the Council for the Advancement and Support of Education issued proposed changes to the case management and reporting standards. Those new case recommendations basically were consistent with CPG's guidelines for reporting charitable gifts. And those have also been endorsed by AFP. So a few years ago, the Sharp Group published this chart that's on the screen to show how 3 different nonprofits counted and gave all ultimate results reported on 3 different campaigns. The difference between the campaigns is how they count planned gifts. So in campaign 1, all the planned gifts were counted at face value, while campaign 2 in the middle counted life gifts at a discounted present value, and campaign 3 did not count any planned gifts at all. And you can see the difference in what is reported out for the campaigns, from a low of 26 million to a high of 60. And I'll talk about the different categories in a minute. So basically, CPG separates gifts into 3 categories. Category 1 is how they count and recognize outright gifts. Category 2, category B, is how they count and recognize irrevocable future gifts. And category C is how they count revocable future gifts. So I would suggest, for more detailed information on this, download the valuation standard for charitable planned gifts and the guidelines for reporting and counting gifts from the CGP website. But I will go over the highlights of each category and explain these to you. So basically, category A are for outright gifts that are usable or will be usable for purposes during the campaign. So these are cash, publicly traded securities, current gifts of non-cash assets, such as real estate if it's going to be liquidated, irrevocable pledges, cash value of life insurance, realized bequests, realized retirement plan assets, realized life insurance. Qualified charitable distributions also fall into this category. So these are gifts that are either given outright one time or pledged over 5 years that will be used during a campaign. So basically, these are commitments that most charities count in their daily line of work. Category B are irrevocable deferred gifts, and there should be a separate goal for irrevocable deferred gifts that are committed during the campaign, but may not be usable until some point after the end of the campaign. So these are your split interest life income gifts, charitable gift annuities, pooled income funds, charitable remainder trusts that have your organization as an irrevocable beneficiary, retained life estates, death benefit of paid up life insurance in which the charity is both the owner and the beneficiary, irrevocable testamentary pledges or contract to make a will, any lead trust distributions. So anything that is irrevocably designated to your organization, but you may not receive or have use of it until after the campaign ends. So we call these irrevocable commitments. Category C are your future pledges, as we call them. A revocable deferred goal should be any gifts that are solicited or committed during the campaign, but the donor retains the right to change the commitment or the beneficiary. So these are estate provisions from a will or a living trust. A beneficiary designation from a charitable remainder trust that is revocable. Any type of beneficiary designation from an IRA or a retirement plan where the donor can change that designation. Any type of a beneficiary designation for life insurance that's revocable. Any portion of a donor advised fund where the donor can change who will get that money, and other revocable pledges. At Penn State, we use face value to report these revocable gifts and for recognition. We use an age requirement. The donors need to be age 60 or older by the end of the campaign. Some charities who report these types of revocable pledges don't have an age requirement. I recommend to the charities that I work with that the age requirement be used. You don't want to count the revocable bequest from a 30-year-old when you won't see the money for 45 or 50 years. So having an appropriate age requirement for recognition and counting purposes makes sense. So why were these recommendations created? Why were these recommendations created? I get this question a lot. The three categories guide both the goals set at the beginning of the campaign and the reporting of results during the campaign period. Results are measured against aspirations and can be clearly stated that all three types of gift commitments are crucial to achieving your goals. That gets back to that chart we looked at a few slides ago. With these goals in mind, staff can have conversations with donors about potential gifts to the campaign. Basically, a three-tiered ask becomes a natural part of the fundraising effort. Even if we are working with donors who are less than age 60 at Penn State, if they mention they've included Penn State in the will or estate plan, we are still documenting that as what we call a future countable. We're inviting them into our legacy society and thanking them for that commitment. Even though that commitment does not count in our campaign numbers, we are still recognizing and stewarding that potential donor. We're also asking that donor to early activate that future estate gift. And I'll get into early activation in a little later. These guidelines enable organizations to count and report all gifts and commitments. So generally speaking, report progress of planned giving to your donor community using face value based on an age requirement for future gifts for donor recognition purposes. However, when you work with your finance and business office for your institution's financial statements, those should only be based on discounted present value of those future gifts. Full disclosure is very important here. At Penn State, we recognize and count gifts at face value, but on the university's financial statement, those future commitments are reported at discounted present value. For capital campaigns, the counting of gifts should be separate from cash and outright pledges. We report these in different categories. So we have cash and outright pledges. We also have our deferred gifts, both irrevocable and revocable, in a separate section. Campaign policies should clearly articulate what you are willing to accept and the rules for counting those gifts. You want to indicate whether deferred planned gifts will receive the same treatment as cash or pledge gifts as it relates to naming opportunities and capital campaign donor societies, which are different from your legacy societies. So at Penn State, we have donor recognition societies for cash and binding pledges. However, donors can get into those societies through an irrevocable estate commitment, which is separate and distinct from our legacy society. We also allow donors to name existing physical spaces with an irrevocable planned gift. We cannot use deferred gifts for new construction, but each organization should look at what they will allow and determine what policies make the most sense. For valuation purposes, we calculate the expected value of a gift in the future, which tells us much about the money and when it will be available. So basically, we are building and charting a gift expectancy chart. So we know how much of our planned gifts will mature in the next 1 to 4 years, the next 5 to 9 years, the next 10 to 14 years. So we basically use a discounted present value over the number of years it will take before we expect to receive the gift using actuarial tables and our expected discount rate at the institution, basically our in-house inflation rate. Since most bequests and other gift planning vehicles are revocable into maturity, We also discount the value of the gift by a probability that we'll get it. Some gifts are very unlikely to be received, and others are more likely. All those details are spelled out in the CGP counting guidelines that you can download from their website. I tend to break gift planning programs into 3 categories. The majority of most programs are young and growing programs that just focus on bequest and beneficiary designations. So most of the nonprofits that are out there are smaller charities. They're asking for bequest designations, bequest expectancies. That's 80% of all planned gifts come as future pledges. So this is a smart strategy. When we look at Penn State and the gifts we receive, about 80% of our gifts come through someone's will or estate plans. The other 20% is coming from life income gifts and other types of vehicles. So most of the counting and reporting of these future plan gifts will fall in the category C that we just talked about. Even if a nonprofit doesn't offer CGAs, they can still market them because there's third-party providers where you can write a CGA, and when that gift matures, you will get the remainder interest in that vehicle. And I know other speakers in this webinar series have talked about some of these outsourced vehicles that you can use. The next category of programs are sort of growing. They're beginning to offer life income gifts, such as CGAs or charitable remainder trusts, where they'll act as a trustee of a trust. Then you have programs like Penn State and other large organizations that are mature programs that offer complex assets, charitable lead trust, family wealth planning. At Penn State, we have about $140 million in assets under management in our life income program that is administered by TIAA CASPIC. So we're a large mature program, but most nonprofits don't fall into that category. So focus on beneficiary designations and bequests. Understand how to count and report them. So the best way to work is to track collaboration between planned and major gift staffs. A lot of small charities, a gift officer might be wearing multiple hats, being the planned gift officer and also doing major gift work. But if you have a separate planned giving officer, it's especially important to track the number of introductions of qualified donors major gift staff are making to the planned gift team. Major gift staff need to be incentivized to make these introductions of qualified prospects to planned giving staff. You also need to leverage partnerships to be successful with gift planning in a campaign. Do internal training on how to utilize complex assets to add a zero to a gift. Talk about how to raise the conversation with donors about planned giving. It's very important to have gift officer metrics. There is no one-size-fits-all solution to metrics. Metrics need to be customized for each program and in coordination with other development activities. So metrics are very dependent on the size of the organization you are and what activity you're doing. But it is important to ensure that some of the performance metrics are shared between planned giving and major gift staff to ensure effectiveness and collaboration between the two functions. Shared accountability and shared credit. Give all gift officers a goal to uncover bequest expectancies and add names to your legacy society. At Penn State, we encourage every major gift officer to add 3 donors to our legacy society every year as part of their goals. In startup plan giving programs, commit 5% of a gift officer's time in contacting loyal donors to thank them for their support and ask them to consider a legacy gift. That's the best thing small organizations can do who have very few gift officers who are wearing multiple hats. The goal is to identify qualified leads for cultivation, not just to document gift amounts. It's also important to set stewardship measures to ensure ongoing dialogue with legacy donors to keep the donors close to your organization. Set a variety of non-financial engagement goals to encourage visits and other contacts that increase the number and quality of planned gift conversations and discussions. If you don't have a legacy society, create one. Most legacy societies only require someone putting the charity in their will and letting them know about it or disclosing other substantial gift planning vehicles. At Penn State, we have a simple letter of intent that is on our website, and we encourage our major gift officers to carry that with them on calls. And we encourage all gift officers to ask a prospect if they've remembered Penn State in their will or estate plan. How many people already have included your charity in their will and you don't know it because you've not asked? Most donors don't have a requirement for documentation, but if your legacy society is one that involves naming opportunities, you should have a copy of the will or clause in the will so you can have proper valuation, can be determined, and the charity can track that estate for future purposes. You should advertise membership and benefits in all your marketing materials for your legacy societies. Public acknowledgement of extraordinary support in your communication vehicles, a special certificate or plaque, an annual reception or dinner, a potential legacy donor wall, all can help with this effort. And remember that a bequest is often the largest and most powerful gift a donor will ever make. A little recognition and donor stewardship is the least we can do to thank them. With that, I'm happy to take questions from people and entertain any thoughts or comments they might have on this topic.
Yeah, thanks, Mike. We have quite a few questions. I think you have answered some of them, but maybe we'll hit them again just to make sure that that the information was understood. So let's see. We have a question from Kimberly, and she's asking if you can say a little more about what getting buy-in from the start looks like.
Getting buy-in from the start is having your development leadership understand and fully embrace what gift planning can do for a program. So every institution I've been at, we've first started with our development leadership to make sure that they value planned gifts. We're properly counting planned gifts and having gift acceptance policies to make sure we can be in a position to accept different types of assets. But also buy-in is with volunteers and the Board of Trustees. It's making a presentation to the Board of Trustees about the impact of planned giving with your program, getting their buy-in so they understand that as volunteers, they should also make a planned gift to the organization in addition to supporting it just with a major or annual gift. So really it starts by getting constituents across all levels of an organization to understand and agree that we are going to have a campaign goal that includes planned gifts.
Perfect, Mike. Again, I know you covered quite a few things around counting, but there's still some additional questions. Just want to make sure everybody's got their things answered. I know Amy had a question around DAFs. Are you counting those, or those counted as a planned or annual gift? And John even had one around, do you ever try to make planned gifts irrevocable?
Sure. I'll answer the one on the donor advised funds first for Amy. At Penn State, we do count gifts from donor advised funds, and we actually encourage donors, if they have a donor advised fund with Fidelity, Vanguard, Schwab, and are going to fund a scholarship or something over a pledge period of up to 5 years, to complete what we call a non-binding intention. So the non-binding intention is basically a statement from a donor saying, I intend to make grants from my Fidelity gift fund to fund a scholarship. I will grant $10,000 a year in each of the next 5 years. And the way we count that, Amy, we put that intention on the record of the donor advised fund and give the donor associated credit on their gift record, because the assets are coming from the gift fund, the donor advised fund, not the donor. So that's where we record the gifts in our gift system, but we want to properly recognize the donor, so we do it with associated credit on their record. The gifts can't count towards our annual giving societies or lifetime giving societies until the gifts come in. So we can't count a 5-year intention. We can only count the grants as they're given every year. So I hope that helps explain that. Regarding the second question, do we try to make planned gifts irrevocable? We do that a lot. for a couple reasons. Again, at Penn State, we do not count donors' commitments to our lifetime giving recognition societies unless they're irrevocable. So if a donor wants to move from one level to another, we encourage them to make their estate commitment irrevocable. And we do what's called a deferred pledge commitment for that. Basically, it's an estate note that's legally binding on their estate. We do allow donors to make lifetime payments against that if they can specify a specific purpose, such as a scholarship or a program support fund. But we have that conversation a lot on making plan gifts irrevocable. And our donors are receptive to it, especially around recognition.
Yeah, I appreciate you going down that road on revocable and irrevocable, because we have 3 or 4 more questions. And again, irrevocable likely, especially if there's a naming opportunity or a chair. There's a question around that if there was some type of designation there. Also around Penn State and publicly reporting campaign fundraising totals. Question was, do you put them into 3 gift categories? Do you guys actually bucket them into outright irrevocable and revocably deferred?
Okay, so regarding irrevocable, making plan gifts irrevocable, we do it because we also, at Penn State, we can name existing physical spaces with an irrevocable plan gift. So not new construction, but for existing space on campus, a classroom, a lab, we can name those, and we have values put on them that are good for 5 years, and we reevaluate them. We will not do an irrevocable plan gift for a professorship or a chair. We need money in the door on that. We will do irrevocable plan gifts around some other things, but anything where we need money to help fund a professorship or a chair, we asked our donors to early activate, which is pledging 5% of the value of that gift for a period of 5 years. So for a professorship, which might be $1 million level, we would want them to pledge $50,000 a year for 5 years in order to put their name on that. And then after the 5-year period, their name comes off the professorship until the estate gift is realized down the road. Is how we work on that, Nathan. Regarding the 3 buckets, we do report plan gifts in the 3 buckets on internal reporting, but not externally. All we report externally are commitments and receipts. So when we do a press release on our giving for a year, we report a commitment number. We don't break that down between the 3 categories that are in the CGP counting guidelines. However, we do track that internally and report that to our campaign leadership and our campaign volunteers. When we report campaign numbers for like VSE surveys or CAE surveys, we take out any gifts in kind that are in there, and we report the discounted present value of life income gifts versus the face value that we do for our internal reports and our campaign counting.
Okay, we have a question from Tim. He wants to know, how do you go about assigning a value for a revocable bequest that's coming through a will or a trust that doesn't have a specified dollar amount identified? For example, the charity is going to receive a percentage of the estate. How do you go about assigning a value to that?
Right. That's a great question, Tim. Specific bequests are easy. If the donor tells you, I'm leaving $100,000 to your organization, but if a donor says, I'm leaving 25% of my residual estate to you, we ask that the donor value that 25% if something would happen to them today. So if a donor says, I'm leaving 25% of my estate to you, when I die, we say, if something catastrophic happened to you tomorrow, how much would Penn State receive? And we ask them to give us $1. So if that's $250,000, that is what we put in the gift system. And by doing that, we track residual bequests versus specific bequests, because when we have the next campaign, we go back to the people who said, you're getting 25% of my estate, and we ask them if their estate has gone up in value. And if it has, we can book that increase in the next campaign we have. So we are very conscious of the people who've done, excuse me, a percentage estate from a cultivation and stewardship standpoint, because we are constantly increasing and picking up that increased number as we move forward. So basically, we leave a blank in our documentation and ask them to fill in a number.
Okay, terrific. No, this is great. And I know we've got a couple minutes left. We've got a ton of questions. So no doubt when you gave us in Philadelphia, I'm sure you had quite a bit of dialogue. So try to, get to some of these, and those that we don't, again, we'll try to share these with Mike, and if you have a chance offline. But there was, again, you spent some time around counting here and the documentation you require for irrevocable gifts. And I may have missed this, but want to make sure Teresa gets her question answered. What documentation do you require to count the bequest? So a revocable gift. But if there is documentation provided and it doesn't have a value, do you code the bequest as 0 or do you use some type of median value?
Okay, so at Penn State, we require 3 things in order to count a gift. First of all, they have to meet our age requirement of being age 60 or older by the end of the campaign. They have to put in writing that Penn State's included in the will or estate plan beneficiary designation. They have to give us a dollar amount, and they have to tell us what purpose the gift is going to be used for. And they can do that on our letter of intent, which I said is on our website and visible out there. However, we really like to document future gifts with what we call a statement of donor intent. The statement of donor intent really becomes the legal endowment agreement when and if a gift's received from their estate down the road. So that talks about the utilizations of fund. It has our endowment administration language. However, we will count anything as long as it's in writing, has an amount, purpose, and is signed by the donor. We prefer a statement of donor intent, as I said, but we're pretty easy in what we document and count. Not every donor wants to sign a statement of donor intent, as it looks more like a legal document, and I understand that. If a donor is unwilling to give us an amount, as Teresa asked, we do not put it in our gift system. We track it as a future countable. So we don't put it in at $1, as some organizations do. So it's not showing up in the gift system under giving. It's showing up as a future countable that we track and monitor that way. We also ask for a copy of their will or the pertinent section of their trust, even with the letter of intent. But if we don't get that, it's not a requirement in order for us to count and book the gift.
Okay, we have a question that's somewhat related from Margaret. This is kind of a long one, so bear with me. She's asking, what do you tell your board of trustees or your management when you're in a capital campaign when they think the age for counting a planned gift needs to be at least 75 years old? This is because they believe the donors will make a planned gift rather than a cash gift, and the board is really trying hard to raise cash. So if they raise the age to count a planned gift, that will allow people or force people to give cash instead of a planned gift, but then they're left with less planned gifts in the pipeline at the end of the campaign. So basically, how do you address that with your board?
We have, and when I came to Penn State, our minimum was 65. We've since dropped it to 60. We did a lot of benchmarking with other peer-type institutions. There's a lot of universities that don't even have an age requirement. But I'm a big believer in analytics and doing benchmarking. The Giving USA survey that just recently came out a few weeks ago showed that the average age at which a donor makes their first planned gift is 52.8 years old. So people are putting you in their will and estate plans at a very young age. I mean, the people are in their 50s. So if you're not actively marketing or asking for planned gifts, they're going to include another organization. So if you don't give people recognition and credit till they're age 75, these people are going to probably, go to an organization where they might get credit. So I think the most important thing for Margaret is to do some benchmarking and show her board some of these statistics. I mean, the age that people first put charity in their will is create their first will is age 44. And that's also in that Giving USA survey. So the average age donors write their first will is 44 years old. So like I can understand where Margaret's board's coming from, feeling that if they lower the age too much, a donor is going to do a planned gift as a fallback. But you can do blended gift asks. You can ask for early activation. There are many ways to still bring dollars in the door without, just taking planned gifts.
Terrific. I know we're getting close to the end, so apologize to those who weren't able to get to some of these questions. I think we did cover a lot of this. Thank you, Mike. We've got a lot of great comments on how much people enjoyed this. I think one that just kind of ties into the broader campaign thing that I have some ideas on too, but Clark asked, again, it sounds like you suggest including planned giving within general capital campaigns, which was the theme of today, and something nationally, obviously we're seeing consistent in that 25 or 20 to 30 range. The question was about how about having a campaign with single focus on planned giving. So I didn't know if you've done that, Mike, in your work, if it's been an endowment focused one where it's solely around planned gifts, or if it's been just a marketing tool around planned giving. But Clark had that question in regards to difference in quote unquote campaigns.
Yeah, no, Clark, that's a great question. At Penn State, or where I've worked, I've never done a single focused campaign on that. But I've consulted with some organizations that have done legacy challenges, and you might have heard about these, where basically they'll have a donor or the institution will put up matching funds to raise bequests. My alma mater, the University of Wisconsin, is doing one of these right now, and they've had great success, where a donor came up and said they would match gifts for donors who create bequests to the organization. George Washington University in DC had great success with that. And John Kendrick down there has presented at national conferences on a legacy challenge. So what I like is doing a legacy challenge versus a singular focused campaign on bequests. If you can find a way to match or incentivize donors to include the organization, the will or estate plan. And I think that's where you would have more success. So the key is really creating a legacy challenge on that. And I think if you Google GW's Legacy Challenge, that'll pop up. And even the University of Wisconsin's Legacy Challenge, you'll see information on that on their websites.
Great stuff, Mike. Yeah, and I think actually even some of the old papers, whether it was John at GW or even some of the a couple of challenges that were done by some folks out of New York City, those may even be on the CGP website too, from some of the past conferences. So great idea. I'll hand it over to Jen. I think we've got some closing remarks here.
Yeah, absolutely, Nathan. I think that is a great idea, Mike. I know that we have quite a few clients that we've worked on legacy challenges with before, so I think that's a popular way to go about doing that, just focusing on planned gifts. Like Nathan said, we are out of time. We want to be mindful of everyone's time. So I did want to let you know that if you had a question that didn't get answered, that's just a burning question that you would really like to talk to Mike about. He has offered his email address. It's up there on the screen. You can contact him. You can also contact Nathan or myself if you have questions about our webinar series. If you have questions about Stelter's products or services, you can visit stelter.com. And one of the most popular questions is, can I get the PowerPoint slides and the recording? And the answer is yes, we did record it, and barring any technical difficulty, I will have this recording along with the PowerPoint slides. And also Mike had another document he was going to share with me. These will be put up on our website at stelter.com/webinars. Look for those to be in place by Monday. So thanks again, everyone, for joining us this afternoon. And Mike, thank you so much for joining us and presenting, spending your lunch hour, your time and talent. I'm sure everyone really appreciated your expertise for this last hour. And Nathan's presenting next month, a month from today, I believe the 11th. Go to our webinars page and you can sign up for that. And we look forward to seeing you then. Have a great afternoon. Bye-bye.
All right, I saw that.